Preface. It was an ice-cold afternoon in December of 2008. A heated discussion about the banking system and the future of the American economy was going on in the lunchroom in my office building. People were pessimistic and worried. Cash is king was mentioned at least 10 times during half an hour of heated debate. Almost everybody wanted to sell their equity mutual funds and move to the bonds. Nobody knew where the ultimate bottom was. One financial institution was falling after the other. Being bank employees, my colleagues were worried about their jobs and future. I tried to calm the discussion and suggested a few investment ideas but failed miserably. Nobody wanted to listen to a word of financial advice. They were angry because their investments in a safe vehicle like a mutual fund were cut in half right before their eyes. They were not taking excessive risks in their minds, so at least in theory, they should not be subject to extreme fluctuations. They were angry with the system, with their financial advisors, and with themselves. They wanted to go back to cash for a while, at least until the dust settled. This discussion, anger, and behavior were not new. All of it has happened multiple times in the past. 2000, 90, 87, 82, 74, 70, 37, and worst of all, the Great Crash of 1929. The ultimate bottom was reached in March 2009, and the market returned to its previous peak in 2013, but without those who moved to cash. Market participants are humans, and so are their behaviors. Humans develop their behaviors throughout thousands of generations, and they are not going to change in a couple of hundred years of capital market participation. Humans' reactions are contaminated with their cognitive biases, greed, fear, and survival instinct. However, capital market success requires precisely the opposite behavior of what your intuition is suggesting. This counterintuitive approach towards markets can be natural for a handful of people. However, for most retail investors like you and I, it is acquired the hard way. We need to spend years making mistakes, learning, and reading. Stocks were not my first choice for investments, primarily because of my fear of information bias. My preferred investment was real estate. I did a few small share transactions here and there, but nothing serious. However, I had to choose a second avenue, and stocks were the most logical choice for diversification. I started trading with a small percentage of my total capital, and it was fun. My partner in crime said one day that investing in shares is like pure entertainment, and the money we lose is like entertainment fees. We were acting like gamblers and were having gambling fun, winning small amounts and then losing all of it, plus some, in one significant loss. If I look back, I had the stupidest day trading idea that required zero market research. I was silly enough to believe that my out-of-the-box idea of day trading would make me millions in a couple of years. This day trading/gambling accompanied the first year of my trading. However, after a significant loss, I decided to take a break and learn about trading. Initially, I learned mostly about day trading and technical analysis. I made several strategies and tried a few of them. The results were almost identical. Winning some small bets and then losing all of it in 1 or 2 trades. It was like running on a treadmill. You spend a lot of time and energy, but after weeks and weeks of gut-wrenching trading, you find yourself exactly at the same spot where you started. It was frustrating. The second year of trading ended with a small loss, but I was hoping for millions. At this point, I gave up day trading altogether and moved to swing trading. My holding period increased from hours to days. Nothing changed in the overall results. At least I was not losing. It was mostly break-even most months. After about a year of swing trading, I took a break and went back to books. Luckily, this time I was mostly reading about the psychological aspect of investing, crowd behaviors, history of market ups and downs, recessions, etc. Fortunately, I never had to learn about accounting and finance, as I am an accountant by trade and had enough knowledge and expertise of financial statements beforehand. My initial target of learning about behaviors was to correct my psychological shortcomings in trading. However, I realized that by nature, I am a risk avoider. I don't have the heart and soul of a successful trader. I am more suited to long-term investing. Once I found my comfort zone, I started long-term investing with confidence. I gave up the idea of making millions in days and decided to earn a modest rate of return without taking excessive risks. To my surprise, I started beating the market comfortably, year after year, while I was not even trying. All I was doing was buying securities without any intention to sell. My journey from day trading to long-term investing was gradual. Along the way, I made every mistake and error that can possibly be made. I sold stocks instead of buying, and vice versa, multiple times. I mixed up tickers and bought penny stocks instead of blue chip that I actually wanted to buy. I mixed up stop-loss settings on countless occasions. I sold at bottoms and purchased at tops. Any mistake you can imagine, I have probably made it one way or the other. Fortunately, none of the mistakes were fatal. I never blew up my trading account. On an aggregate basis, I was almost break even on all of my blunders. Some of my mistakes made excellent profits. Once, instead of selling, I bought the shares, and by the time I realized my error, the stock was 15% up with my accidental double position. At that time, this was my biggest profit ever. On the other hand, the result of my intentional trading was a mix of gains and losses. I was break even on my trading most of the time. Because of these mixed results, both in deliberate trading and accidental mistakes, I gradually developed the concept of randomness as fantastically elaborated by Nassim Taleb in his brilliant book, Fooled by Randomness. I am an avid reader, and since I started investing, I have read hundreds of books on investing, particularly on stocks. Slowly, I developed my own peculiar set of concepts on common topics. My approach towards investing is strictly from the point of view of a retail investor. I have never managed other people's money. That's why my thought process is not contaminated with concepts that are necessary for money managers. For example, for me, a market crash in December is no different than a January crash. I would behave identically. However, there is a world of difference between the December crash and the January crash for a money manager. Because of this difference, they behave differently in December than in January. I don't. And as a retail investor, neither should you. Don't get me wrong. Nobody is born with investment concepts. It is an acquired knowledge for all of us. My set of ideas and concepts is a cumulative reflection of my readings and experiences over the course of many years. However, when you read hundreds of different authors and engage in investing day in and day out, you develop your own set of concepts, right or wrong. My set of concepts towards common investment vehicles played a vital role in my investment success. I gradually started making money consistently, and over time, my investment results became better than market averages by a wide margin. This book is a summary of my understanding of stocks and capital markets. I genuinely believe that these concepts can help you or any other serious investor, particularly long-term retail investors. Secondly, I was encouraged to write a book about investing because there are only a handful of investing books written by retail investors. Most of the books were either written by money managers or by professors. This book provides a unique point of view from the perspective of a retail investor who worked a routine, non-investment related job, but has a keen interest in stocks and capital markets. My formal education as a professional accountant and my work experience in banking helped me a great deal. My learning curve was much quicker. I tried to structure this book for retail investors who have basic knowledge of financial products and investments, but want to expand their understanding of markets, cycles, and human behaviors. This book can be an excellent first step for them. I briefly touched on all essential topics, and I hope it will provide you with a baseline for further readings. This book is neither about investment ideas nor strategies. This is not a journal of my investment career or a chronological summary of significant market events. Instead, it is a book of concepts, which in my opinion, are essential for a successful investment career. It guides the reader on how to navigate market ups and downs, and turn a disastrous market event into a once-in-a-lifetime opportunity. Investment success is all about how well you understand the concept of financial risks and potential rewards, and how you behave during booms and busts. I tried to provide guiding principles while discussing essential concepts in easy-to-understand language. I briefly touched on academic discussions, like modern portfolio theory or efficient market hypothesis, but intentionally avoided going into details. Instead, I spent more time describing financial risks and psychological behaviors, which are, in my opinion, much more essential and critical for retail investors. I want to say thanks to all those authors whose writing crafted my concepts and ideas. Without those books, I couldn't have succeeded in stock investing, nor could I have been able to write this book. I learned a lesson or two from every book I read. However, some authors made a significant contribution to my understanding of capital markets. Among those authors, John Bogle, Howard Marks, Nassim Taleb, Philip Fisher, and Warren Buffett were the most impactful. I also like to say my deepest thanks to every person I quoted in this book. These little gems of thought are the best possible words to describe the relevant concept. I may not entirely agree with every word, but it was impossible to illustrate the topic correctly without these words. I would also like to thank my colleagues and friends who tolerated me for years, and with whom I spent many years discussing silly investment ideas and theories. I thank every person who shaped my ideas and concepts one way or another, especially people on the other side of the trades I took. I have learned to recognize that there is another living, breathing person on the other side of my trade. This other person, who can be much smarter, is willingly risking his or her money in precisely the opposite position. I must say thanks to every person who contributed to the writing and publishing of this book. Many thanks to my editors, designers, and the publisher. Their efforts of countless hours resulted in turning a collection of haphazard paragraphs into a book. The contribution of my immediate and extended family is beyond any words of formal appreciation. I cannot say enough thanks to my parents, in-laws, wife, kids, and other family members who made me what I am today. Without their help, contributions, and sacrifices, this book would not have been possible. Naved Abdali, April 2021.